Hello, and welcome to a fresh new episode from StackWealth, an investment education initiative brought to you by StackWealth, your trusted partner in building wealth through smarter investments. A quick look at the monthly data released by AMFI will show you that in the month of September 2024, equity mutual funds witnessed large net inflows worth about 34,400 crores. What stood out, though, was the quantum of inflows into sector and thematic funds at about 13,254 crore. Although inflows were lower than the roughly 18,000 crore in August, inflows to this category have risen steadily and substantially in the last few months. Now, that's a huge amount of money heading into this category of equity mutual funds. Elevated inflows since May have meant that the category assets under management have increased by 38% till September 2024. That's just in 4 months. This category also has the highest number of schemes at 183 as of the last count on the 30th of September 2024. I'm sure you too have a few sector funds in your portfolio, and if not, you may be tempted to get a piece of the pie. Sector and thematic funds might be the flavor of the season. However, let's not rush into any investment decisions before analyzing risks and other parameters. As the name suggests, sector funds invest in stocks from a specific sector, such as banking or healthcare, whereas thematic funds focus on a broader theme that spans multiple sectors. A theme refers to any economic aspect that drives revenues for a set of companies. For example, while banking and healthcare are individual sectors, infrastructure is a theme that might include companies from the oil and gas and metal sectors. Other themes could include manufacturing, consumption, ESG, or portfolios filtered by quality. In terms of investment scope, sector funds have a very narrow focus, while thematic funds are broader in their stock selection. Despite these differences, both are classified as pure equity mutual funds. When plotted on a risk scale, sector and thematic funds typically feature higher risk compared to other diversified equity funds. Of the two, sector funds are considered riskier due to their concentrated exposure to a single sector, while thematic funds, though broader, still carry a relatively high concentration risk. Historical data on standard deviation, which measures the volatility of returns, reveals that sector-based funds generally exhibit higher volatility than their thematic counterparts. It's important to note, however, that the risk associated with each fund can vary. So, it is essential to assess the specific portfolio risk before making an investment. Consider the example of a banking sector fund. The profitability of banks is significantly influenced by the interest rate cycle, which banks historically performing well in a rising interest rate environment. This is because banks can adjust lending rates upwards faster than deposit rates. While lending rates are linked to floating benchmarks and adjust quickly, deposit rates, including those for fixed deposits and savings accounts, take time to catch up. This dynamic boosts profitability in the short term, although this advantage tends to normalize over time. However, banking sector funds may struggle in a declining interest rate cycle, as stocks within the same sector typically react similarly to macroeconomic changes, leading to concentrated risk. Sector funds have a narrow focus and are subject to concentrated risks, such as cyclical downturns and sector-specific factors like government policies or raw material prices. In contrast, thematic funds are broader than sector funds but narrower than diversified equity funds, as they include multiple sectors within a single theme. While both categories offer more targeted investment opportunities, they carry higher risk compared to diversified equity funds and require careful analysis before investing. Sector funds are highly cyclical, with performance often tied to specific economic factors. For example, IT sector funds benefited from favorable currency movements in the early 2000s but later collapsed due to overvaluation. Similarly, consumption stocks tend to perform well after good monsoons but may struggle in subsequent seasons. Investing in these funds requires a nimble approach with clear entry and exit strategies to capitalize on favorable conditions while managing the inherent risks. New investors should avoid sector funds and instead consider broad-based thematic funds that offer a more diversified approach. On the other hand, experienced investors can consider sector or thematic funds, provided they understand the associated risk and are able to time their entry and exit points effectively. The allocation to sector or thematic funds should depend on your overall equity portfolio and personal risk tolerance. These funds are typically added to boost returns from favorable sectoral trends, but should not form the core of a long-term portfolio. Several instances highlight the risk associated with sector and thematic funds. For example, the IT sector in the 2000s collapsed due to overvaluation, leading to significant losses for investors. Similarly, infrastructure funds in 2008 suffered poor returns following market peaks. These funds are best suited for tactical, short-term exposure rather than being relied upon for long-term strategic investments. If you're considering investing in sector or thematic funds, it's important to analyze the fund's theme or sector thoroughly. Have a defined timeline for your investment and plan your exit strategy before investing. Disclaimer: mutual fund investments are subject to market risk. Please read all scheme-related documents carefully.
Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching and goodbye.